In this exercise, what we're going to do is put together a fair bit, in fact, most of the calculations that we've been looking at in the first few weeks of the unit. And we're going to be doing this by solving a genuine consulting problem of the sort that is encountered when you're looking at optimal use of property. So this is real property economics. It needs the skills of a valuer applied to maximising the performance of a property situation. In this one, we've got Bob Smith, who owns a parcel of land and it's due for redevelopment. And in the situation, he has got certain data, and so the data is listed out there, the cost of construction to the highest and best use. That includes development finance, development period, and a number of other factors we're going to look at. I invite you to take a moment and actually look through those items of data. There could be other items of data that he may acquire if needed. In this exercise, we're going to say we've got everything there. The other thing is that some of these items of data he might have, but he may not necessarily use. So don't feel bad if you don't use everything, but that's what's available. And he owns the land. He's not a developer necessarily, but he wants to get the best performance out of his block of land, and he has a certain amount of property investment nous, a certain understanding of the property market, but he wants a specialist consultant like you to tell him the best thing to do. And given his limitations, he understands that the actual building of the taking the property up to the highest and best use by building something on it is not something that personally he's able to do. So he's happy to stand back and let someone take over the actual construction and so on, and perhaps more of it, as he just wants to know what the best thing is within his capabilities. And so he's considering three options. One is to lease the land to an investor, might be an investor organisation, who does have the skills he doesn't, who is able to do building, design, construct, the administrative side of development, getting DAs, all that stuff, and would also be interested in leasing land, managing the land for its economic life, which here we're taking as 40 years. And so the first option is to lease the land to somebody who can have the skills to make the best of it. So we're going to call this person an investor. They're really a bit more than an investor because they are a property developer investor, really. And there are a number of these in the Australian context at present. And we'll look at applications where we actually find this happening shortly. But more and more people are waking up that maybe this may not be a bad strategy. Okay, so Bob Smith isn't a builder developer or an investor, but he's going to lease the land to somebody who is, and they will construct the building and lease it to tenants for its economic life. Now, there's an interesting thing to reflect on here, that development is seen to be a high-risk, exciting activity that involves cranes and excavators and lots of tradesmen and project managers and all that stuff. And that's where the developer gets his income. But if you look deeply, okay, we've hinted at this when we've looked at the development valuation, but we've also covered some other topics in this unit and also other units that you've studied. It should give you a far deeper understanding of what the developer is doing. And one way or another, the real money in development comes from two sources. One is the uptick in the land values, and the other is the developer's profit and risk. Now, where we have the developer's margin on costs here is 26%. Okay, that could be another number, but it's just what it is. We've already have the construction of the highest and best use, including the construction finance. We'll call it, it's down here as construction finance, we'll call it development finance. So we have that, which means that the builder is able to do what he does and finance that and make a reasonable profit. On top of that, you've got the developer's profit with this secondary and separate profit. Okay, so the investor will want to take both of those, the profit which is lurking in here for the builder and also as developer, because the developer does, at least notionally, accept a high level of risk, and so he could just go in and do his magical development work on another block of land that maybe he owns, and then he would expect that 26% to come off on top of the cost of construction. So he might have one company doing the design and construct, maybe even two companies, one doing the design and the other doing construct and so on. And then there's the developer, which comes in and puts an extra margin on top. Okay, so the investor is going to be doing all this. The only thing is he's going to be doing it on somebody else's land, in this case Bob Smith's land. Okay, and then you see, if the developer is merely making his is merely making his money because of the risks he's taking in putting up the buildings and a certain amount of sales risk, and then as an investor there's the investor risks, finding tenants, maintenance, and so on. Okay, but that is normally conceptualized as relating to the improvement, not to the underlying land. Okay, and so the developer should be able to be happy chappy, earning his 26% on top of whatever he makes as a builder in this first line, the 772,000. Okay, and Bob Smith wants to know whether, if he's going to have a happy developer investor doing all that stuff that he cannot and doesn't want to do, then he will still end up with the uptick in the land values that he'll be able to capture and hold, off for the next 40 years. Perhaps he's thinking of his grandchildren or something, and good on him. Okay, that's the first option. So I've got to think about what that means in terms of the cash flows that is going to flow back to Bob Smith. And I want you to ask yourself at this stage, what is this looking like in terms of the exercises that we did, self-correcting exercise with the yellow patches and stuff, yellow highlights. What does this look like? Okay. I probably shouldn't tell you, but there is one of the exercises at least that looks very much like this that we've already done. Here we can actually be putting it into practice, and we've got to be thinking through where the cash flows come and go in this circumstance. Okay, the second option is to sell the land to a developer. Okay, because that's what developers like to do. They do their feasibilities, you do the feasibilities. You've done them now in a couple of units at least, so you know how to do that stuff. And the normal routine, the stock arrangement, is for the developer to do his sums, come along with a landowner who might be a farmer or a little old lady sitting in a cottage next to another little old lady who's sitting in another cottage, and the developer says, hey, these two blocks of land are going to be really good to build a set of walk-up home units in, and offers the two little old ladies what they think is a fabulous price, and they skip off merrily, and the developer goes off and does what he does. So here, it's more conventional. Selling land to a developer with a settlement deferred to the end of the construction period. Again, not an uncommon development strategy, because the developer doesn't want to be exposed to the approval risk, and so by deferring that, especially when they take an option, is very useful, because it means that the developer isn't putting his money on the line at that first point in time, because the whole approval process, the design process, for a complex development, can take, well, certainly over a year, often a couple of years. And so selling the land, delaying that for as far as possible, can be helpful to both sides. Okay, that is, the developer will pay for the land on the completion of the construction, and this will give Mr. Smith a one-off payment at the end of the construction period. Okay, Mr. Smith, therefore, is sitting on a certain amount of risk, because he's going to have a big hole in the ground in this block of land that he's going to own. And so that, is an ugly thing if you have to sell a half-built building. It actually depresses the value, despite all the money that's been poured into excavation and laying the foundations, whatever the stage is up to. It's not a pretty situation when you have to sell an unfinished development. So Mr. Smith doesn't want to accept that. Well, that's something for the detail between the negotiation of Mr. Smith and this developer. But it's very simple. It means that Mr. Smith gets this one-off payment, and he's able to just waltz off without having to worry about, the patience of having to get these little payments, like the ground rent effectively in option 1, off for the next 40 years before he takes back the land. Okay, the third option is really bite the bullet stuff for somebody who's not experienced as a developer, and that is develop and hold the property using development finance. And so the first data item, 772,000, basically assumes that the financing cost of getting the development up is actually in the 772, so it actually means that we don't have to worry about that. We could model it, but we don't have to. We've simply got that number already provided for us. So he's going to do that, then lease it to tenants for its economic life, and so he's going to be able to basically take all of the rent himself, unlike the first option where he has to share the rent between the person who effectively owns the building and himself, who still owns the land. And there he gets all of the rent, but of course he has to pay for the development. So what his plan is there is to take a credit foncia loan, a principal and interest loan, at the point of completion, and that will be for $772,000, and then pay that off over the 40 years. And so out of the rent that's coming in, he also has the outflow, which is the debt servicing cost for that credit foncia loan. And we all know how to do those. Credit foncia loans are probably one of the most basic ordinary annuity calculations, so we just do that. We're going to be using Excel built-in functions for most of this, because we've been introduced to them. You've been practicing with them over the last, well, certainly the first few weeks of the unit, depending on when you do this exercise. And so deducting that debt servicing cost is important. Okay, and at the end of the day, Mr. Smith will end up with a net rent after debt servicing over the life of the building, plus the reversionary value of the property at the end. Okay, we're going to assume that all of the revenues and payments are going to be made annually in arrears. That simply keeps our calculations easy. Now, does that mean you have to do that? Not at all. But doing that adjustment to have it, say, monthly in advance or something, simply adds just a layer of complication that at this level of analysis we have chosen not to indulge in. We can do relatively simple one-off adjustments just to basically bring everything forward by 6 months if we want to do an estimate of what it would look like according to, shall we say, more precise data. And one of the things about doing all of this sort of work, whether it's development feasibilities or this more advanced valuation option computation, is that it's meant to make decisions by, not to give you to the last 5 cents what the value actually is. Because there are going to be vagaries in there. You're going to have cost overruns, you're going to have changes to interest rates, you're going to have all sorts of stuff. We want to know whether option 1 is better or worse than option 2, and that's better and worse than option 3, and then from that to make a decision. And then in 40 years' time, we'll come back and say, was that a good idea or not? Given the way the world goes, an aeroplane might fall out of the sky in 20 years' time and destroy the building. And at that point, Mr. Smith says, "Oh, rats! I wish I'd sold the land right at the outset to some poor goose of a developer. He's going to end up with a broken building with an aeroplane sitting in the middle of it or something." So those risks, you simply, it's just not our job to model those entirely, but we want to be able to tell him which option he should do. And again, risk and return, give some thought to the way that the capital asset pricing model that we did in former units is telling us that return isn't everything. We also have to consider our risks. Some of those are relatively subjective. As we do this exercise, it'd be very, very useful for you, for your education, so that you can get more of a feel for how this works off into the future, is to give thought to where the risks are and also what the patterns of cash flows are. Now, in a lot of or at least a couple of the exercises that we've done in the first few weeks of term, in the exercise spreadsheet, I've tended to devote a page to doing cash flow diagrams, which look like what I colloquially refer to as up arrows and down arrows spread over time. And if you write those things out, it is really, really useful to get your head around what's going on here. You can say, "Oh, I don't need that, I'm going to use a computer or something." Yeah, good on you. But a bit of scribble paper, whatever, table napkin and bring it home from the restaurant, whatever it's going to be, piece of paper, and those up arrows and down arrows are very, very useful to help you conceptually grasp what's going on. Because this is quite a complex problem. Okay? And the options have their own, rather peculiar sometimes, set of cash flows and options and how to work with them, how to calculate the answers out best. Okay, that's the background to the question. Let's jump in and start to work through the solution. Now, in this solution, we're basically looking to answer 10 questions. Okay, 10 questions are down here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 9 of them are answers to calculations. One of them is the big granddaddy question: what other issues should be considered and what is the final recommendation? Okay, the other issues are going to be things like risks and so on. And what is the final recommendation? Well, that's which option are you going to do. Okay, that's a text question, it's a thinky question, it's a decision question. The rest of them are numbers that are only giving us a bit of a head start there. Now, to get those 9 numbers, we're going to find that we're going to be needing to do some other calculations as well, and some intermediate calculations. To make that easy in this exercise, I've actually laid out what those other calculations are. So they're listed down here. There's actually one little maverick over there to the side as well. So we could probably even bring that in there. They're both related. The value of the property at the end of the lease, and then the present value of that property value to the landowner. Okay, they're 2 numbers. So these are intermediate calculations we're going to be doing. And to make things even easier, I'll put these little red numbers in, or maroon numbers, and they give us a hint as to when it's appropriate to do these computations as we work through the puzzle. And over here, more maroon numbers. And again, this is the order of operations. So the first thing we want to do is this one, work out the total that the developer needs to recoup. Then we come down and we'll do this one, the investor's compound rate of interest. Then that enables us to do the investor's required annual income, and basically we're down. So you just kind of basically follow the numbers. So that's about as much by way of hints as I think we can benefit from. at this point, and so we'll be able to get in and do the numbers. Okay, I would like you to check as we go through whether this makes sense or maybe there's a different way of doing it, and yeah, we'll go from there. Okie dokie. Well, let's get into it. Okay. Let's look at what we need to do here. We're working towards the first question we've got. The first serious question is the investor's required annual income. Okay, that's basically the month-by-month slice out of the rent that the investor needs. And so to do that, we first of all got to work out the parameters, if you like, of the what the developer has got in, what he's contributed to the investment in this case. Okay, in this case, Mr. Smith just sits back. The developer comes in and does the building, so that means he's got to pay for the money. He's actually putting the 772 up. Okay, but that's not all. Even though that includes the builder's profit, it includes the construction finance side of it. I'll call it the construction finance side. The investor here is also acting as the developer investor actually, and so he wants an extra margin on top. So we need this 772 to be grossed up by 26% to give us the total that the developer needs to recoup. So that's going to be the first calculation we're going to do. Okay, grossing up. We're just simply going to be adding 26% or 0.26 to the 772,000. So that looks like 772,000 multiplied by 1 plus the development margin. Very simple. Working with margins is a lot easier than working with IRRs. But there we go. We've got now the 772 has become 972 because that's what the developer believes, intends to recover over the next 40 years, because he's put out the $772,000 over that 45 months, and he needs to get that back plus his rate of return. And so his rate of return as an investor is investor's discount rate 12%. Okay, so we've got the 772 done. Next thing we want to do is we've got to recognize here that while we've got a number of rates of return, they're all going to interact with each other. And this is a great opportunity for you to think about where these things fit in the whole scheme of things, right? We've got the developer's margin, so that's the investor working as a developer. But then down here, we're talking about the investor's discount rate. Whoa, it's only about half or even less. Why is that? Okay. Why is on one hand he's saying, yes, I want a 20% margin, and on the other he's saying, I really only need 12%. I mean, is he pulling a leg or what? Okay. The reality is, first of all, the development margin is a simple margin. It's not an IRR, it's not a discount rate, it's not something complicated. It is just simply like a profit that the shopkeeper might put on a can of beans that he buys for $1 and sells for $1.20 or something. He's put a 20% margin on. So that's what that is. Whereas this is coming from the investor's required rate of return to run his business, his weighted average costs of capital, very often WACC in some cases, right? So that's what's going on there. Okay, so we could say, well, we've got the investor's discount rate, which should be what he's going to be using in order to amortize using the annuity calculations, this $972,000 back. But then there's one further wrinkle here. In simple DCF calculations, you'd have column by column by column for the next 40 columns in order to look at the rent, which is coming up, which is going to be growing period by period. And then you're going to be discounting those back to the present. And so on one hand, the rents and the slice that the investor might want to take out is going to be growing into the future. But on the other hand, you want to discount those future cash flows back to the present. Now, you do that in a conventional long form discount DCF. Here, we want to roll it all up together. And so we want to have one calculation that both grows the numbers, grows the rents that are coming in and the slice that the investor is going to take, and then simultaneously discounts it back by the investor's discount rate. And so for that, we use the investor's compound discount rate. Go back to where we introduced this in class, right? Because it'll be kind of useful. Now you can see that we actually need this thing in action, because with this two calculations are able to do which would otherwise be an absolutely, huge blackboard or something full of numbers and calculations, literally scores of calculations. We're going to be turning down to two calculations by doing this simple trick, and we introduced it when we first introduced you to the idea of using compound discount rates. The compound discount rate is done by basically combining the discount rate that we're looking at, in this case the investor's discount rate, the 12%, and then adjusting it by the property growth rate. Okay, because the property growth rate is causing prices to go up, and then the required rate of return is actually pulling them down further off into the future, the less valuable they are. Let's see how that works. That's going to be 1 plus the investor's discount rate, close brackets, divide 1 plus the property growth rate, and from that we subtract 1, and it looks like we're going to have to format that, and we'll probably put a couple of decimal places in there. So even though the investor is looking for 12%, the fact that inflation or the property growth rate is kind of helping to the extent of another 3%, the net there is that if the investor does his discounting on the basis of roughly the difference between these two, 12 minus 3 is 9. Here we've got precisely 8.74, which is pretty close to 9, so just ballpark, eyeball it, and you can say, yes, that's about the right net result by the time the investor's discount rate is connected to property growth rate. Okay, now we've got the numbers we need in order to work this out. Because we've got an investor who has got $972,000 sitting on the table. He's paid that. He wants to get back over the next 40 years using 40 equal payments that are actually not equal. They're going to be escalating. And then he wants to discount that back to the present. And so this is a pretty typical payment calculation. We want the annual income, which looks like a payment. So we're going to use the Excel PMT function. And we've got all these lovely hints here. So we've got the rate, which is going to be the compound discount rate, comma, number of periods, which is going to be 40. We're going to have the PV, which now I'm going to put minus in here because that's just, I'll let you think this through, but it's part of Excel's sign conventions. Okay, that means the investor requires an annual income of $88,083 per year. Okay. Now, that means that if we can work out the rental on completion, we've actually got that. And here I've done a little bit of video magic and changed one of the data items, which I was supposed to do before I started, but I'm too lazy to go back and re-record the last half hour. And so I've changed the data that we're given from the value on completion to the rent on completion, 180. And so let's assume that is our data going into the game. And from the rent on the completed property and the payment, the annuity that the investor wants to satisfy his financial needs, realise his 12%, given a 3% growth, and the fact that he's got $972,000 out the door, we can work out what is left for Bob Smith. And that's simply a matter of taking $180,000 minus the 88, and it means he gets $91,000 in his pocket every year for the next 40 years, and then he gets his property back in reversion. Okay, so at this point we can go and we can look at what the NPV of the ground rent through the lease is, because Bob Smith is going to be getting these payments off in the future. They are going to be escalating off in the future and so on, so we're going to be using compound rates. Well, we can work out what it's going to be. We've got the ground rent, and here we want to turn that into a present value, a net present value. So here we're going to work out what the PV is, given the rate. Now it's interesting, you see, when we worked out the investor's needs, investor's situation is annuity, we use the investor's compound discount rate. Here we need to use the landowner's compound discount rate, which I just noticed. I've violated my own rules here, and I've gone to try and do item 7 when I haven't done item 6. So I'm going to put that in. That's the rate over there. Right now it's 0, but I'm going to fill that in shortly. Number of periods is 40, and the payment is going to be minus, for the sign convention, of the ground rent. And we'll put that back, close it off. That's, well, 3.6 million now, but don't pay too much attention to that because we're using a 0 discount rate. Here, we're just going to come up and we're going to put in a nice compounding calculation again. That's going to be the landowner situation compounded against the growth minus 1, do. I'll just format that. Okay, so the landowner discounts at 5.83%, and so by doing that, that 3 million or whatever it was before has now diminished down to 1.4 due to the effect of the discount rate being higher than 0. Okay, so that's the cost. That basically is the benefit that Bob Smith gets from doing that particular strategy. Giving his land over to a developer investor, not seeing it again for the next 40 years, but getting that. That's the cash flow he's going to get over the next 40 years. However, it's not all he gets, because he also gets the benefit of getting the property back at the end of the game, at the end of the end of the investment period. Okay. What we have to do is add into this the present value of the property, the reversionary value of the property in 40 years' time in present value terms. Okay, and so what we want to do is, first of all, go back up here to item 8. We're a tiny bit out of order here, but it doesn't matter. Okay, value of the property at the end of the lease, we're going to do that. We're going to work out the value at the end of the lease. Now here we've got the property value on completion. Looks like we've got to work this one out. Okay, and here we've got another value which is a little bit out of order. I should have done item 11 before I did item 8, but I hope you can adjust. Okay, one way or another, we need the property value on completion. We're going to escalate it off into the future. And so here we're going to multiply that number by 1 plus property growth, close brackets, raised to the 40th power. And that won't give us very much because we don't have a property value on completion yet. And we'll do that right now. Property value on completion is the completion of the construction. Okay, we know the rent on completion. That's great. And we also know the gross yield on completion. And so we just capitalize, simple old cap valuation. And that gives us that number over there, which we'd put a bit of formatting around. Okay, so it's the $180,000 worth of rent on completion is going to turn into a capital value on completion, is in 45 months' time, of $2 million. And then by the time we escalate that over 40 years at 3%, we end up with $6.5 million. Fantastic. Okay. What we want now is to work out the PV of that to the landowner, and we can put that down here, PV to the landowner. Here we're going to do a present value from a future value. We can use the Excel built-in function, or we can do the old-fashioned longhand way where we take the future value and now we're going to divide it by 1 plus growth rate raised to hang on, no, it won't put that in, we'll put that in. Now I'm just thinking there, we've got this as 1 plus the growth rate. That actually will bring that back down to the present. However, that actually is not the answer for this. And I'd like you to give a little bit of thought to why that escalation level, the D12 escalation, the 3%, is not the right factor, the discount factor. This is actually a discount factor to apply here. A little bit of a drum roll, give some thought to that. And hopefully, with a bit of reflection, you'll say, yes, okay, the property is escalating at 3%, but the landowner, Bob Smith, has to wait for 40 years to get his money, to get his 6.5 million. Now, he's not interested in the property growth rate in terms of his required rate of return. His required rate of return is actually up here somewhere as 9%. And so while it's escalating at 3%, Bob Smith having to wait 40 years to go and get this money out of the project means that from his point of view, he's actually going to discount that future cash flow by his required rate of return. Okay? Take a break here if you want to think through what's going on here. Okay? In these last few numbers, we've actually dealt with about 5 different escalators, discount rates, whatever you want to call them. We've had the investor's discount rate, and we've had the investor's compound discount rate. We've had the landowner's 2 rates. We've had the investor's 2 rates, and we've got the property growth rate. We've got to know when do we use each one of those, and to do that, we have to think through what's going on in each one of these cases. Here, we've escalated to the 6.5, and then we're going to de-escalate. We're going to discount using the landowner's discount rate, not his compound rate. We probably do it with his compound rate. Let me do that, and we will format that so it's nice and pretty. Okay, so it's 207 cents, 207,000. Just as a little aside, I'm going to come over here, and I suspect no, I won't do that. I suspect that if you want to do a bit of exploratory maths yourself, I won't demonstrate here because it'll just take us away from the flow of the thing. By using the the landowner's compound discount rate, I think you should be able to get the 207,000 from the 2 million a bit faster. Okay, I'll leave that with you to consider. Anyway, for the moment, I'm just going to leave that number just sitting there, because one way or another, Bob Smith is going to earn $1.4 million as the present value of the rents he's going to receive, the ground rents he's going to receive, plus in 40 years' time he's going to get today's equivalent of 207,000, at least in his terms. That's the first option that he's really considering. Just to look at that, it means that in total he's going to be earning or getting from the property the PV of the 40 years of rents plus the PV of the end value of the property, and so that gives him a total benefit from option 1 of $1.6 million. Okay, give some thought so that you're totally happy with what that is and why 1.621 is the benefit of option 1 to Bob Smith. While you're doing that, we will get in and look at option 2. Now, option 2 is selling the land to the developer. So let's look at what we've got here. The developer needs to recoup the cost of construction plus his profit risk, which is the number that we've calculated way up earlier. So we'll just bring that down. Okay, so required return, in other words, the dollars he wants to pluck out of the project is 972. He's going to have a property value of $2 million on completion. Okay, where does that leave the landowner? Well, the developer in 45 months' time is going to be able to sell the land if he wants for $2 million. It's cost him $972,000, including his P&R, in order to be able to get that. So he can afford to pay the residual between those two numbers to the landowner. That gives him $1.027,000, and that is the benefit to Bob Smith if he takes option 2. So option 1 gives him 1.6 million, option 2 gives him 1.027. That's fairly easy. That should remind you of the ground rent stuff that we're looking at and the way that we've got this combination between the improvements and the land in in partial interest problems. Okay, some of them do a tidier job than others. Okay, now we need to move on to the develop and hold option 3. Develop and hold the property using development finance, so it's 772, and then lease it to tenants for its economic life. And here, Mr. Smith is actually getting some builder to come along and give him the development at a cost of $772,000, and after that he's going to have to rent the property, pay off the loan that he's going to get for the 772, assuming he's 100% debt financed in this case, and see what comes through. Okay, we're going to have to see, he's going to have a 40-year credit foncier loan with a principal of 772. We want to work out what the payments are, so we'll do that as our first task here. So we'll do payment, open brackets, The rate is going to be the interest on an investment loan, which is 11% in this case. The period is going to be 40 years. And the present value is going to be the 772. We'll put a negative in there to get our sign conventions working happily. That'll give us $86,000. So every year he has to pay out $86,000. That means the net income to the landowner is the rent minus the $86,000, which means he's getting $93,000, at least in the first year. That's going to escalate. And so now we want to work out what the net present value of the of that $93,000 coming back to the landowner, to Bob Smith, is. And so here we're going to be looking for a present value function. Our rate is now, because it's going to be escalating, and we're looking at the landowner, we want the landowner's discount rate. Number of periods is 40, and the payment is going to be, we'll change the sign there, put in the 93,000, and that'll work that out for us. And so it means that the equivalent benefit is over the 40 years of the ownership is going to be 1.44 to Bob Smith. Okay, so that looks good. As well as that, you've got to remember that Mr. Smith is going to end up having the property in 40 years' time, because he's developed it, he's holding it, he's investing it. And so at the end of 40 years, okay, he's got a 40-year-old building, but he's still got that coming back to him. So we have to add to that the present value of the reversionary value, which is this 207. So the option 3 value to the landowner in total is equal to the 1.44 plus 1.621. No, sorry, my mistake there. Not that, it's that, which is 1.647. Okay, so the options look like, if he leases the land to the builder investor, he will get the equivalent of 1.621. If he sells the land and just sells the land, he will get 1.027. And if he retains the services of a builder, and I guess also somebody to work out his approvals and so on, he's going to be looking at 1.649. What do you choose? Well, obviously 1.6, well, close enough to 1.65 is bigger than 1.62, and so and they're both bigger than 1.027. So it looks like on a dollar value, option 3 kind of takes the cake. In practice, as you have more detailed data, because he's taking this role himself, he's basically taking the role of the developer here as well as the investor. That might require skills that he may want to subcontract out. That might eat away at that 1.65, okay? But it's really a matter of whether he can afford to spend $50,000 to get the skills he needs, maybe a town planner to do whatever he's going to do, whatever. On this scale, that would probably still leave option 3 as preferable. Okay, so answering question 10 here is really a matter of looking at these 3 numbers, that one, and also making sensible observations about what other little risks and issues might be kind of lurking in there. But that's the problem done. That's really about as complicated as you're ever going to find in professional practice, I expect. There are lots of places that look a bit more fussy. You might be faced with, populating a development feasibility that's, has got millions of little cells and whatnot in it. You might be faced with doing something else using a similarly horrid-looking corporate spreadsheet that asks for lots and lots of stuff, especially in the investment area. The investment appraisal kind of work can get complicated. But in terms of the thing about those is they tend to be just a matter of populating a spreadsheet with relatively simple calculations. Here, it's a matter of, if you like, creatively applying relatively, and I'll say relatively because some of you won't believe me, relatively simple calculations. Basically, I'm just using no more than the annuity calculations that we've done since business finance, and we certainly did a bit of a refresher in the first weeks of term with those self-correcting exercises. So if there's still a bit of mystery there, go back to the exercises that formed the first few weeks of our unit and just see what's actually going on here. Because while this looks obscure and complex, it's just a matter of applying these tools, relatively simple tools, but knowing what you're doing. Because knowing how to apply them and how they fit together, that's the clue, okay? And once you're able to conceptualize any popular property investment that you can think of, once you can conceptualize it and put it in terms of sets of cash flows, you've actually got all of the mathematical power in what we've done in these first 3 or 4 weeks to be able to pull that off. Here's just an example of it. Don't simply memorize this and say, oh, okay, now I've got a template to solve this kind of a problem. That's not the purpose of this exercise. This exercise is not to solve this particular problem. It's to show you how you can solve off-the-wall problems using the tools that you've got. It's simply a matter of being familiar with the tools and their power, familiar with how to interpret some property event, development, investment, some hybrid of the two, interpret that in terms of a pattern of cash flows. So as long as you take the event, interpret it in terms of its cash flows, then you then apply these tools, right? And the rest is up to you. The more practice you do with this, the better and more comfortable you'll be with it. So don't go off and, because you're doing resi valuations or what have you for the next 5 years, because that's just your position in the company, and you forget all this stuff. What a waste. Okay, you've got an extraordinarily powerful toolkit now that enable you to calculate and resolve any complex valuation or property economics puzzle that anyone's likely to throw at you. So just think about the tools you've got and practice applying them. Go over this exercise again. Go over it step by step to see those parts that might be a bit clunky for you, and think about it until you're comfortable that you understand why each part is done. And then all the best with your career.